Let's start.
Wait, Vedant, ICM Moto song will be played initially, and after that we can start formally.
वेदांत स्टार्ट करो।
मिश्रा जी, आप चालू कर दीजिए मोटो सॉन्ग प्लीज।
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यति कश्चन एतद्वैता 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 एतद्वैता।
Thank you, team, for the ICI Moto song. Good evening to one and all. Respected Vikasa Chairman Jitendra Sanglani sir and WRC Chairman CA Ketan Sayya sir, WRC volunteers and all the enthusiastic attendees of this session. I wholeheartedly welcome you all in this amazing session in our ongoing Gyan Yagna series, which is aimed at deepening our understanding and strengthening our professional foundations. In a world brimming with data, the real power lies not just in collecting information, but also in interpreting it. And when it comes to the language of business, finance is absolutely crucial. So today we embark on a journey in the hearts of financial understanding, the ratio analysis. This session aims to provide clarity, guidance, and practical knowledge about financial and ratio analysis. Today's discussion is not only essential for entrepreneurs and business owners, but also for young aspiring chartered accountants who are looking to understand the backbone of successful organization in the world of finance. And for this great topic, we have an eminent speaker, CA Udit sir. I now request CA Jitendra Sanglani sir to kindly enlighten us with his valuable words. Over to you, sir.
Yeah, thank you so much, Mr. Vedant. The Wings of Vikasa, that is volunteer at Vikasa. Chairman of the region, most respected CA Ketan Sayya sir. Along with him, CA Pinky madam, the regional council member is there. Team Vikasa. And my dear students, along with that, I just missed to mention the speaker, CA Udit Choithani. So friends, we have this third session in the valuation series wherein CA Udit Choithani would be talking today on ratio analysis. I think ratio analysis talks about, say, key aspects of a balance sheet, of a financial statement. And while understanding ratio analysis, I think it's very, very important that we understand this particular topic in much more detail, because when it comes to investing, we need to understand what the ratios are telling us. And ratios are the indicators that guide us whether we should be investing in a certain aspect, in a certain entity or not. So I think very key topic, very important topic. And see, Udit, I know Udit for very long now. 2018, he was one of the Vikasa committee members at Nagpur branch. And from there, the transition has happened. So he has now, come as a speaker before all of us. So the journey is very say immense, and he has been nice and kind to us for accepting our invitation and joining here as a speaker on this particular important topic of ratio analysis. I welcome you, Udit, on the forum of Vikasa WRC, and I look forward to have a very wonderful learning experience for students through this session. Friends, we have another session on startup valuation, which is happening on Monday, that is 30th of June. And I'll request everyone to kindly join for that session. CS Ruti Dev would be taking us through that particular topic. And friends, regarding the forthcoming events of Vikasa, we have an educational tour happening at Ahmedabad, which is on 11th and 12th of July. And the first batch is already full. And I'm very happy to say disclose that. But we are planning with one more batch on repeated request. And let's see if we can roll it out tomorrow. So stay glued with the activities of Vikasa. Friends, we have national conference also coming up in the month of November. So I should tell you that this is one of the one of those times wherein you should all get involved and be a part of that national conference. And we'll be rolling out the details very soon. We have back-to-back activities and events happening. Tomorrow we have NTS, that is National Talent Search, at the regional levels happening at WRC BKC. And I welcome all the participants of that NTS as well, which are actually have come forward from branches as a winner, and they are participating here. So wish all of them a very happy, wish all of them a great success tomorrow, and to you all, very happy learning. With these words, it's over to you, Vedant.
Thank you, Jitendra Sanglani, sir, for your kind words. I now request CA Ketan Sayya, sir, to kindly set the tone for this session.
Thank you so much, Vedant. Before I speak, I have a privilege of past Vikasa chairperson and regional council member Pinky Madam with me. I'll request Pinky Madam to address all of us.
Hello, and first of all, I congratulate our WRC Vikasa chairman, CA Jitendra Sanglani ji and his team, because I can vouch that since last 4 months, when after he took the chairmanship, n number of program he is doing, and with the support of his very enthusiastic and very supportive Vikasa team, they are day and night they are thinking about अभी क्या करना है. अब एक दिन में 2 प्रोग्राम भी कर सकते हैं, ये लोग इस सिचुएशन पे आ चुके हैं. And like Jitendra sir told that Vikasa student is now the speaker in Vikasa, so it's a very great motivational to all the Vikasa बच्चे लोगों के लिए भी कि they also can be a speaker in future. And for valuation, I can say for ratio analysis, I will advise all the students, please take pen and paper to note down the crux in ratio analysis. It's a technical session. It's not कि आपने खाली सुना और आपको समझ में आ जाएगा. You have to pen it down. और उसमें क्या क्या मेन पॉइंट है आपको समझना पड़ेगा. आप खाली ऐसे कान में लगा के रखोगे उससे नहीं होगा. आपको ठीक से पूरा रेशियो का मतलब समझना पड़ेगा कि कहाँ से कैसे उसको कैलकुलेशन किए हुए हैं. तो आप साथ साथ में उनके करते जाओगे तो आप समझ पाओगे. खाली सुनने से आपको कुछ नहीं समझ में आएगा रेशियो में. एंड दैट रेशियो इज नॉट ओनली फॉर वैल्यूएशन. आपको कहीं भी आगे कुछ भी फाइनेंशियल एनालिसिस भी करनी है किसी की बैलेंस शीट की, देन ऑल्सो इट विल हेल्प यू. सो good learning, better learning. For better learning, you have to keep concentrate for full session, not for 15 minutes or not for 20 minutes. You should be aware, you should be alert for full session. And thank you again for inviting me here. And good learning. Congratulations to you all. Thank you.
Thank you, Pinky Madam. Chairman Vikasa Jitendra ji, the learned speaker Udit, and very, very happy that he is a past Vikasa member. Our Vikasa team members, Ashi, Vedant, and all of you. Thank you so much for allowing us to talk to the student for 2 minutes. I think a fantastic series is on valuation. And today's topic is again very, very important and very relevant. Any financial statement which we get in life, I think the first way, simple way to, analyze and check is the ratio analysis. Of course, the way ma'am said, it is right that we need to understand ratios, and ratios can be manipulated very easily. So parameters on the basis of which these important ratios are set are very, very important. And my congratulations to the team Vikasa for keeping this topic, which sounds very simple, but not so. But of course, it is very, very important. So heartiest congratulations, team Vikasa, to think through about hosting a meeting on ratio itself for the use of valuation. Thank you so much. Over to you, Vedant, again. Thank you.
Thank you, Pinky ma'am and Ketan Sayya sir, for your invaluable words. Now I would like to welcome our welcome Mr. Himesh Raja to introduce our dynamic session for the speaker. Over to you, Himesh.
Yeah, thanks, Vedant. Hello. Good evening, everyone. It is my privilege to introduce to you CA Udit Choithani, a dynamic CA with over 7 years of diversified experience in financial management, auditing, taxation, and regulatory compliance. He has worked with leading firms, including Deloitte, as an audit and assurance senior. He is also the founding partner of UN Associates, where uh, initiatives in bookkeeping, management consultancy, and tax advisory. He has served as a faculty member for professional courses like CA, ACCA, and CIMA, and also authored many insightful pieces for various platforms. CA Udit exemplifies perfect blend of technical expertise and passionate mentorship. To join me in welcoming CA Udit Choithani. Sir, over to you.
Yeah, should we go ahead?
Yes, sir.
So is Jiten sir there or he has left? I just wanted to add something what he added to my introduction. Jiten sir just talked about my journey from being a Vikasa member to the Vikasa or the student a speaker in the Vikasa event. I just wanted to mention that when I was the Vikasa member, he was the Vikasa chairman. So that journey from the branch Vikasa to the WRC Vikasa is also something amazing. Yeah. Chalo. Let's go ahead. I'll just share my screen. I just want this to be a very interactive sessions. So I have kept my chat box open. So whenever you feel a doubt is there for the students can directly ping over their doubts into the comment box, right? So I'll share my screen, starting with understanding financial ratios. Is my screen visible?
Yes, sir.
Yeah, PowerPoint presentation. Okay. So, starting with understanding financial ratios, I just want you to get a brief on ratios and want to, clarify that we cannot solely rely upon the ratios. Say, for example, ratios are just like signals, the traffic signals. Okay. So, when you are on a traffic signal, there is a red light. So, what does it infer? That you stop, and when there is a green light it infers that you can go. But when there is a green light, can you just see nowhere to the left or to the right and just go straight away? No. Why? Because someone from some direction might be coming, he might be breaking the signal, which may get you injured, right? So ratios also are in the form of signals. You can follow them, but you cannot blindly follow them. You have to cross check, you have to interpret and understand the ratios whatever they are saying. Yeah. So in today's session, there are a lot of ratios in ratio analysis with respect to the finance perspective. There is a whole chapter in CA final, rather in CA intermediate also. But what we will be covering in the next 1.5 hour will be the ratios which are of utmost importance while you are in the process of understanding, in the process of analyzing a company or a prospective balance sheet or PNL from that perspective, right? Chalo. So, and we'll be practically solving those ratios as well. This PPT is just for understanding a few things. Yeah. So there are a lot of type of ratios. believe, yeah. So there are a lot of type of ratios. The first one being the current ratio, or rather we'll start with the liquidity ratios. So every ratio first is a signal with something. So while analyzing the ratios, you need to understand which signal are they. Is that a green signal? Is that a red signal? What does that signal or what does that ratio communicate? So starting with the liquidity ratios explain you about the short-term financial position of the company, right? Say, for example, will I be able to run the company for the next month or for the next 3 months, 4 months, 5 months, 6 months, whatsoever, but in the short term. So, starting with it, the first one is current ratio, which already we have been learning about, which is current assets upon current liabilities. So, just give me a second. Yeah. So, what we have been doing, I believe my screen is not visible now, right? Yeah. Can anyone confirm if it is visible or not? Yeah, not visible.
So not visible.
Yeah. So that is what I was wanting. So I'll share my whole screen with you, entire screen. Yeah. So I'll share my whole screen with you because we will be learning with real life examples. We'll switch to the PPT in between, but profoundly we'll be going with this. So what we have done, we have taken a company, Vedanta Limited. Okay, everyone knows about Vedanta Limited. Please confirm me in the comments. Or you want to, yeah, well known. So Kalpit seems to be very active. Unnati, Jay, very nice, very nice. So Vedanta is into mining and steel, as all of us know. So we have extracted the financial statements of Vedanta. If you can see over here, we have the balance sheet over here and we have the P&L over here. And then we'll be having live examples of ratio analysis. I haven't calculated the ratios. I have just linked the relevant figures over here. Okay, so first one beginning with the current ratio, as we have already talked about what current ratio tells us about the liquidity of the company, about the liquid position, that whether the current assets, what are current assets, the assets which we expect to realize within a short period, or rather we expect to realize, if we go as per the definition in Ind AS or rather the accounting standard, which we expect to realize within a period of 12 months from the reporting date, which means that we are expecting those assets to convert into cash within a very short period. So, and the same is current liability, whether the liabilities will have to pay within a period of say 12 months from the reporting date rather. So whether my current assets are able to fulfill the current liabilities. Say for example, I have a few current liabilities, I have a few current assets. So if tomorrow all my current liabilities stand and say nahi mujhe aaj hi paisa chahiye, so will I be able to liquidate my current assets? Will my current assets be able to pay off those liabilities? Okay, so naturally the it should be more than one, because less than one is a very drastic what I can say is very poor ratio, but in an ideal scenario it should be two. Okay, so now we'll check what the financials of Vedanta Limited say. Okay, so we have the current assets, we have the current liabilities, and current assets upon current liabilities here comes to 0.93 and 0.94. So I just want again all of you to answer whether this is a good number or not. Yeah, so Kalpit has said no. Yeah. So why is this not a good number? So my current assets will be able to fulfill only 93% and 94% of my current liabilities what I have right now. Right? So an ideal ratio is 2, but a good ratio, at least 1 you should require. But is this a good thing? Is this a very bad thing? No, this is not a very bad thing. The company is just struggling over a few things. If now the company is struggling with few things, for that you need to understand, you need to deep dive in. How will we deep dive? Just understand that what this ratio communicates, that the current liabilities are less than current assets, right? This is a red signal, as we have already discussed, that if this is the thing, the company's liquidity position is very poor, what we can think of. But if you go into the balance sheet and you look at the current liabilities, only the creditors or the trade payables are only 10,000 crores. The numbers are in crores, whereas the advances from customers are 8,000 crores. So this advances from customer is considered as a liability in the balance sheet. Why? Because we haven't fulfilled the obligation as per Ind AS 115 or AS 8. We haven't fulfilled the obligation, and that is why it is standing in liabilities. But what the crux is that we have received already. We have already received this much of amount, right? So if we eliminate this much amount, let's figure out that what happens. So if I eliminate this advances from customers, if I eliminate advances from customers, then the current ratio comes at more than 1. It is still not very healthy, but you need to understand that why the ratios are signaling like this. Okay, if we initially took all the current assets and all the current liabilities, it was throwing a red signal. But now it has come to orange if we understand that in current liabilities there were advances from customers. So we have already received the money from the customers, which is which was later gonna get converted into debtors rather if we haven't received that. So this is advance payment. So in our current liabilities, we can at least remove that to understand, because we do not have to pay that back. We just have to deliver the goods, right? So you can look it from both the aspects, with considering it, without considering it. But more important is understanding why that ratio is throwing a red signal or a green signal or an orange signal, right? Any doubts with current ratios? Or what we'll do, we'll cover 3-4 ratios at in one stretch, and then we'll switch to doubt session. Okay. So now coming back to liquidity ratios, the next ratio is quick ratio. Okay, so what is quick ratio? Now imagine a scenario where which I have already built up a scenario that tomorrow all my liabilities, all my current liabilities come to my office and say, यार हमको तो आज का आज पैसा चाहिए, we need the money right now or today. So what I'll do, I'll be liquidating all the current assets and will be paying them off. But say for example, in my current assets there is inventory, right? Will I be able, or will the creditors listen that I'll say, okay, I'll pay you, you take my inventory? Is that a practical scenario? Will they be okay with it? No, they will not. So they'll not be okay with it, and I cannot liquidate my inventory instantly. मैं अगर वो माल जो भी मेरे पास पड़ा, whatever inventory I have, if I'll go to sell that, it will take some time, right? So to understand that we have a quick ratio. Okay. To understand that we have a quick ratio, whether my quick assets, right? Quick assets क्या होते हैं? Quick assets is all your current assets excluding your inventory, because inventory cannot get quickly converted into your cash, and hence you won't be able to pay that to your sundry creditors or whatsoever. So to arrive at the quick ratio, what we have to do, we have the formula for the quick ratio is very simple. You just have to take the formula of current ratio, but in assets you have to reduce the inventory. So we'll do it here. The current assets are 54,000 crores, or we'll omit crores, we'll talk in thousands only, and we'll lessen the inventory, and which will get divided by current liabilities. Okay, so this is your current quick ratio. So again here the quick ratio throws what we can say, a red signal. Yeah, I have a doubt of using Google Sheets and not MS Excel. Oh, there is no specific reason. It's just that I've been using the G Suite which is developed by the institute, and that is why using Google Sheets. Nothing specific reason not to use MS Excel. Yeah, and I'll appreciate if we can only talk about the technical queries over here. Yeah. So again, this is throwing a red signal. Yeah, sure, Jiten sir. Again, this throws a very red signal that the quick assets, which I can convert quickly into cash, are not as much as my current liabilities. So yes, this throws a red signal. But again, if you deep dive into the balance sheet, if you can see, there are other liability items 40,000 crores, which are what we can say. Taken into account for current liabilities, and if you deep dive into that, you will be able to understand that whether this 40,000 crore, or rather 40,000 rupees, should be taken into account for calculating the quick ratio. Okay. Yeah. Other current assets like prepaid expenses should also be excluded. Yes, definitely. See, you have to actually determine your actual liabilities and assets. Okay, so prepaid assets are that's what I told you. Prepaid assets are something that you have already paid for, but you haven't received the services. So that could be excluded at arriving, and if you include that, you will have to include both the prepaid expenses and the prepaid incomes or pre-received incomes, or if you plan to exclude, you should exclude both of them. There's nothing like prepaid expenses in the Vedanta balance sheet. So but that's what you have to explain you what are the some quick assets other than cash and marketable securities. There might be what we can say, the debtors are quick assets. Why they are quick assets? Because you can go and get them discounted in some bank or with some discounting agency. So debtors also you can consider. You might say that debtors are not quick assets because if I go to any debtor, he'll not pay me immediately, but you can get it discounted from banks. So debtors are quick assets. Okay. So this was quick ratio, which shows us tells us about the liquidity position, and then we come to the cash ratio. Okay, so what is cash ratio? Now that's what we were talking about. That even if I consider debtor in quick ratio, there is a possibility that debtors might not pay me immediately. Okay, so then we take a cash ratio that okay, what if the debtors are not paying me immediately, the inventory is not getting liquidated, the marketable securities, I just have cash, bank balances and marketable securities. So okay, then we'll analyze that what is the cash ratio. The cash ratio is, again, you have to just take cash and cash equivalents in place of current assets, and in the denominator you will have to take current liabilities, which is very poor if we talk about Vedanta, right? But if we talk about Vedanta, which is very poor, then again, if you go deep dive into the balance sheet, you can understand that there is this other liability item which is worth rupees 40,000 crores over in there, which forms a major chunk of the liabilities part. I was unable, or rather, we'll have to look into these, that what actually is this. Similarly, if we go into the current assets, there are this 30,000 worth of other asset items which are still yet to be figured out whether it falls a part of the current assets or what actually is that. So again, if we look into the ratios, the cash ratio here is I'll be able to fulfill only 16% of what my current liabilities are. Okay. So these were about the current the liquidity ratios rather. So these were the three liquidity ratios which tells about the current or the liquid health of the company, whether it will be able to pay its present obligations with the present amount of cash it holds. Yeah. Moving to the next one, we have again a few liquidity ratios. Basic defense interval ratios. this is a very new ratio, not a new ratio, but this is a very new terminology because we haven't, or rather, I haven't studied it in my inter or rather CA final. What is this basic defense interval ratio? So you need to understand when when India was in a sphere that the startups in India were growing like anything. So the one of the main principles of startup is they initially burn cash, get the customers acquired, and then they start playing profitable. So in that case, we'll have to understand what you might have heard of that. What is their runway? So this is nothing but runway. Now, what is runway? Runway is basically the cash lying in my bank and my obligations. Say, for example, I have 2 crore rupees in my bank. I have 2 crore rupees in my bank and I have obligation of rupees 1 crore a month. The fixed obligations, the salaries, and all those things. So, if I have an obligation of 1 crore a month, I'll have to understand that I have a runway of 2 months. After 2 months, my funds will be over, and then I'll have to again look here and there for the funds. So, this basic defense interval ratio also tells you about the same. You have to take the cash and bank balances, net receivables, and marketable securities. So basically, your quick assets, and you have to divide it by the daily operating expenses. This ratio is in terms of days. So if you take daily operating expenses, yeah. So as you can look in over here, you have to take daily operating expenses, and then you can derive that how many days we can run, how many days a company can run on its present current assets, on its present current assets. Okay, I'll address the queries, but first we complete this particular ratio. So what you can see, the cash and cash equivalents are 4,000, the receivables are 30,000, and the payables are 18,000. So the net receivable is the sum of this minus the payables, right? So the net receivables I have is of 18,000 in 24 and 19,500 rather in 25. And the operating expenses are say near to 1,08,405 and somewhere 1,10,625 here. So now my operating expenses per day, come to if I divide the operating expenses by number of days, which is 365. So roughly 297 crores and 303 crores are the operating expenses per day of Vedanta Limited, right? So we have to understand with these operating expenses per day, how many days we can run the company without bringing in a single new money. Okay. So that what we do, we take the net receivables or the net assets and divide it by operating expenses per day. So you can see that in 24 we were able to run the company for 63 days without bringing in a new rupee. And in 24 the ratio has shifted to 64.5. So this is basic defense interval ratio. So by the name you can understand that what is our basic defense. What at least we can survive the company for the next 63 or 64 days. So now you'll be asking me, sir, ये company डूब जाएगी क्या? नहीं भाई, ये नहीं डूबेगी because the receivables are in a recurring position. This ratio is mostly used for new companies or new startups where we are in a cash burn position and not yet profitable, so they need funds to run their company. But in this case, where the receivables are moving and in fact the payables are moving, this is not a very crucial ratio in for a new company, for established company, but it is one for new companies. Okay, we'll look at the doubts. So so we need detailed adjustments while calculating ratios. See, as I told you, ratios do give you a very good indicator, right? Ratios do give you a very good indicator, but until unless you analyze those ratios, the ratio analysis is not very fruitful. Say that's what I told you. There is no specific detailed calculation. You will have to use your what we can say, your professional skepticism as we learn. You'll have to use a professional skepticism. Like when I was also not planning to give this as a specific example, But when I calculated the current ratio of Vedanta Limited while I was looking at it in the afternoon, I just saw ki, it is a good company, it is giving good dividends, and it is the share is also doing good. But why is this current ratio so poor? Then when I deep dive into the balance sheet to understand why the current ratio is so poor, I came to understand that there is an item of advanced income received in advance. So there is no specific formula. The formulas have already been given for the ratios, but you'll have to use your common sense, or rather what we say in our CA, the professional skepticism, right? So you will have to use your professional skepticism in order to analyze the ratios properly. Although for Schedule 3 we need to include all current assets for valuation, it is judgmental. See, Schedule 3 is something which is from a regulatory perspective rather. So that is what I told you now. When you churn the numbers, when you derive out the ratios, you will understand whether there are a lot of things in which are required in Schedule 3 somewhere, but at the time of calculating ratios you have to put them somewhere. So somewhere reclassification is needed, but Schedule 3 is all about the compliance part, or not totally about the compliance part, but it should give a true and it should give a fair view of the items. Yeah. So it is judgmental. It is the ratio analysis is itself a judgmental thing. Depends upon industry to industry and company to company, situation to situation. Exactly. It depends. That's what I told you. You'll have to use a professional skepticism everywhere. That's what I told you, that if you see a red signal, you don't go blindly. You still check left and right whether someone is not breaking their signal and they can come and ram into yours vehicle. Okay, so you will have to, even if you get a good signal from the ratios, you will have to at least go through the balance sheet to understand why those ratios are putting that kind of figures over there. Okay, chalo. So the basic defense interval ratio we were talking about, the basic defense interval ratio is 63 and 64. That means without putting in a single new money into the company or into the organization, we can run for these many days. Yeah. Coming back to the PPT, the next ratio is net working capital. Net working capital is very simple. It is a measure of the cash flow that you can bear in the present time. So here we have also net working capital calculation, which is current assets minus current liabilities. I believe. Oh, current assets minus the current liabilities. Yeah. So I believe I may not go into detail over this ratio. We have already been working on it a lot. So yeah, net working capital is current assets minus current liabilities. It shows basically how much funds have you got for the if you pay off all your liabilities and all your assets. Yeah. So what one thing you can see over here, this net working capital is coming positive because our current ratio has shifted to more than 1. There is a direct linkage mathematically also. I may not go deep dive because we are already CA students. We understand these basic things. If this current ratio goes below 1, this net working capital will directly get negative. Okay. So yeah, coming to the next part of ratios, capital structure ratios. The funding and the leverage ratios, very important in today's times, because what is happening right now, that startups are getting hefty valuations and then they are being brought down. We have very good examples like Byju's, or in fact there was this company wherein MS Dhoni had invested. I am Blue Smart or some electric vehicle company which got funded heavily, and then it turned out that there is nothing like there is nothing worth the valuation it got. So these ratios typically indicate you how is the capital structure in the company. So I just want you to comment in the box that you have two companies similar in all aspects, but one is a company which is fully funded on its own. There's no debt, and one is a company, there is say for example, if there is a debt in the other company, which company would you go for? The company with no debt or company with debt? Yeah, Kalpit, right. HDB Financial's IPO. Let's wait for the listing and then we'll actually come to know what it is. Yeah. So Diksha, no debt, no debt, debt. Jay is saying debt. Okay, no debt. So no debt. Likely leveraged. Likely leveraged is a very what we can say, a balanced kind of answer. We want either yes or no. Okay. So I'll tell you. So in inter, whatever subject it is now, I don't know. But in inter, you might have studied that the cost, when you take the cost of debt, when you take more debt, the cost of the weighted average cost of capital is mostly less if you introduce debt than total equity, right? But that is from the company's point of view. What from an investor's point of view? I will not be going into a company which has debt, because being an equity investor, if the WACC is higher, so it's I only will be get paid if the WACC or the cost of equity is higher, right? It's only I will be get paid. So one thing you need to understand, that the company which does not have any debt is much more better than a company which has debt. No doubt the cost of debt is little lower than the cost of equity, but that is from the company's point of view. From the investor's point of view, I would always go for a company with minimal or no debt. Okay, so here's our first ratio. The first ratio is equity ratio. What is equity ratio? Equity ratio is something which tells us that out of the total assets, how much of the assets are funded by equity, or how much assets are funded by the owners, because equity holders are the owners. So how much, what part of the assets is being funded by the owners or the equity? So if you see here the shareholders equity, now I'll also come to this. The shareholders equity is 42,000, whereas the total assets is 1,88,000. So if we take out shareholders equity, this will say come somewhere around 22%. Okay, this is 22%, and here it is 26%. If I take it into percentage, this is 22% and this is roughly 27%. So now what you understand is, again, the company has been unleveraging its portfolio. The company has been paying off its debts, right? Because the equity ratio has come up, and it is a significant increase. If we say 5% in a span of 1 year, it is a very significant increase, and you can see the commitment of the management to unleverage itself or to pay off the debts. So this shows the value of the management, how much the management wants to pay off its debt, and this is still a green signal. Rather, now you can take this as a red signal as well as a green signal. How do I take it as a red signal? Because if you understand that only 22% and only 27% of the company's assets are being funded by the equity. So this is a very, or this is rather a very concerning thing, because only 20 to 27% of your assets are being funded by the equity shareholders. But if you see it on a year-on-year basis, this is a positive point, that you are paying off your debts. You do not want more debt in your company. You are not bringing in any debt. Rather, you are bringing in equity, or you are paying off the debt so that this equity ratio is increasing. Yeah. So that is what I again told you, that ratio analysis, there is a very good saying on that, that beauty lies in the eyes of the beholder, right? So similarly, the analysis lies in the eyes of the analyst, rather, what we can say. The similar That's what I have shown you in the shareholders equity thing. Okay. Yeah. So then again, there is this similar ratio. As we calculated for debt, we'll have to calculate it for equity as well. As we calculate for equity, we'll calculate it for debt as well. So the total debt is 87,000 crores, whereas the total assets is the same 1,88,000 and 1,88,000 and 1,99,000. So now again you understand that 46% of the assets are being funded by debt and 45% of the assets are being funded by debt. Now there comes this one question. Okay, what do you take into equity? Can someone tell me what do you take into equity? Or what does this equity mean? Can anyone in the comments? SC plus OE, share capital plus reserves capital, right? Have you so we'll go to the balance sheet first. So the equity capital is 372 crores roughly, and the reserves are 30,000 crores. So this comes to 30,000 of equity, 30,722, and in the next year this comes to 41,000. So, but here we have taken the ratio to be 42,000, 53,000. Can anyone tell me what is the missing figure here? Why is this figure more than the equity and the reserves lying over there? Jay, I'll come to your question once we complete this. Yeah, can anyone tell me what is the missing figure? Or share capital not allotted yet, maybe. Yeah, that's what maybe. So if you take a deeper look at the balance sheet, you will see this thing. Yeah, I have highlighted this. I'll highlight this in some color. Can you see what I have highlighted? I'll bold it. Yeah. No, not decrease in retained earnings. Yeah, this is non-controlling interest. What do you understand by the non-controlling interest? Can anyone in the comments? And is it right to take non-controlling interest into equity? Yeah, minority sale of no, not sale of stake. Arpit is very near, but Yash, it is not sale of stake. Non-controlling interest, yeah, minority interest less than 50% holders. So if you would have learned about consolidation of accounts, so you might have understood when I consolidate the subsidiaries incomes and the subsidiaries balance sheet into mine, we have to provide for the people who are the non-controlling interest. Means, say if I am the holding company and I have 70% stake in my subsidiary company, these are the rest 30%. Yeah, the percentage not held by the holding company. So this will also fall into equity. And that is what we have answered over here. Okay, so this includes three figures: your share capital, your reserves, and your non-controlling interest. Okay, then again we come to debt. Someone asked a very very good question and very what is the purpose of showing non-controlling interest? The purpose of showing non-controlling interest again lies into AS and Ind AS. Maybe we can cover that some other day, but just to tell you that, say if I am the holding company, and I imagine there are two sides, assets and liabilities. Okay, I am the holding company. I have 70% of what I can say. I have 70% of the subsidiaries. So if subsidiaries has an assets of 100 and a liability of 100, I consolidate all 100 into mine. You say I consolidate all the 100 assets and 100 worth of liabilities into my books of accounts, right? But I hold only 70%. So in order to nullify that 30%, we put in a minority interest that even though I have shown this 100% into my books of accounts, this 100% is not mine. There is this liability, or there is this other equity which is held by the minority interest, which is worth 30%. So this is what I can tell you right now. Rest, if we have a session on index someday, we'll go into detail. Okay. I believe I have answered your question, Aditya. Yeah. Okay. I'll go forward. So someone had asked a question that why is not debt ratio and equity ratio coming at 100, right? So see, understand यहाँ पे हमने जो debt में लिया है, what the figures that we have taken in debt is actually the debt, and we have not considered the current liabilities. So if you take out a third ratio, current liabilities to total assets, all three of this will come to 100, but not this, because some of the assets are at least funded by the current liabilities. Got that? So you have got 100 assets, and you have to determine that how are my assets being funded. So in this case, 22% of the assets are funded. 22% of the assets are funded by equity, and if we add that, so 22% are by equity, 46.62% is by debt, and the rest are being funded by the current assets, current liabilities. Sorry, current liabilities. Yeah, hope I made it clear. Yeah. Chalo. Now let's come to the very next ratio, very talked about ratio, which is debt to equity. Okay. So what is this debt to equity? I need to understand that if I am the shareholder, okay, I am the shareholders. I need to understand that how much debt has my company taken, because I am the shareholder, so I can rightfully say it as my company, because as we have learned in the definitions in our earlier classes that equity holder is as good as the owner of the company, or he is rather the owner of the company. So I need to understand, if I have put in 1 rupee into the company, the how much multiple of my 1 rupee has the company borrowed, right? So if we come to debt equity ratio, the total debt about upon shareholders equity, again here we are considering only debt and not current assets. Okay, so we are considering only debt, and in equity we always consider non-controlling interest into equity. Okay, so if I calculate debt equity, so this comes to 2 and this comes to 1.7. Now what inference is this a good number or a bad number? I want in the chats. Good or bad? Just one word answer, good or bad. Kalpit says good. Bad. Okay, I have one good, one bad. Bad, two bads, three bads. Chalo. Yeah, Unnati says good, good, good. Okay, so there is a very balanced opinion. So that is what again we see, that the beauty lies in the eyes of the beholder. So if I see debt is in 24 or in 25, debt is twice the amount of equity, which is a very bad indicator. Debt is twice the amount of equity. So if equity is 42,000, debt is at 87,000, and then this year if equity is at 53, the debt is at 91. Right? But then again, what is a good number is the company is repaying its debt. We have seen in the earlier ratios also that the inference is coming that the company is very what we can say, the company is very desperate to pay off its debt, and that is what being reflected in the ratios, right? Yeah, that is what being reflected in the ratios. If you can see over here, हमने कहाँ पे देखा था, the company is wanting to pay off its debt. Okay, let's. So the company is repaying its debt. So, and then naturally, then equity will slowly come forward, and I am very keen to see what happens in the next 2-3 years, because at what the pace Vedanta is going, we can I believe that it will be debt, not debt free, but it will be able to bring the debt equity to 1. Let's see what happens. What is oh sorry, I thought current one was above 2. No. For DCF modeling, sometimes we use debt upon market cap. Instead, see, DCF is a very different thing over here. Okay, we can use debt upon market cap because market cap is something which is with respective to the valuation, or rather when you want to derive the valuation of the company. But when you study it with respect to what we can say, investing into it or deriving the valuation from the books of accounts? Before that, we'll see unlock via demerger of Vedanta final position of the company. Yeah. So you can use debt upon market cap, but market cap is a ratio wherein the investors have put in their money. Say for my example, if the company has issued a share at rupees 1, which is now trading at rupees 100, okay, though the company has got only rupees 1, the company has got nothing to do with that 100 which is trading in the market. If that share is trading in the market at 100, the company is not getting 100. The company has got that 1 rupee or maybe whatever, including the premium the company might have issued that at. Right? So both the things are very, what we can say, very correct. You can take the book values, you can take the market cap for DCF modeling, because therein you discount the cash flows. Here we are not discounting anything. And the DCF method is wherein you estimate the future cash flows. So that thing is very different than this. But yeah, that was a good question, and I hope I have answered that to your understanding. Yeah, correct. So now I hope everyone has understood the debt equity ratio. See, again, I am telling you that you can take a look at all the ratios with very different angles. It is upon you how you conclude that, how you come to the conclusion of that. Okay. Chalo, let's go to the next ratios, which is again debt equity ratio हो गया अपना. Debt to total assets ratio, again we have studied it earlier only. यहाँ पे हमने जो निकाला है debt to total assets is 46-45%. Capital gearing ratio is a little important ratio. Can anyone tell me using the formula what does it infer? या यहाँ पे तो दिया हुआ ही है interpretation. So now understand, मेरे पास दो चीजें हैं. I have this equity, I have this debt. ठीक है? But we have issued a few what we can say financial instruments, like say preference shares, which are bearing a fixed interest or which are bearing fixed return. I have promised some fixed return to the investors into those preference shares. So for that, I will, though the preference shares are like equity to me, but they are in nature equity, that is in nature equity capital. They will get paid whatever after the debt is getting paid. But when I take that into what I can see, when I see that as a investor's perspective or with respect to valuation, I will have to understand that those at least bear fixed interest. So you will have to understand that apart from that debt, if there are any fixed interest bearing funds in the company. Okay. If there are any fixed interest bearing funds in the company. Understood? So this is the ratio. This is nothing. This is a modified debt equity ratio, wherein in place of debt, you will also take those figures when you have to, which are in the nature of equity, but you have a fixed obligation to pay returns over there. Okay. So यहाँ पे हमारा debt equity ratio say comes to around सेम जो हमने वहां पे लिया था, बिकॉज यहाँ पे ज्यादा फिक्स्ड इंटरेस्ट बेरिंग रेशियोज है नहीं. ठीक है, यहाँ पे देर आर नो मच फिक्स्ड इंटरेस्ट बेरिंग रेशियो, द डेट द कैपिटल गियरिंग रेशियो कम्स टू सेम. बट इफ इन केस देर आर प्रेफरेंस शेयर्स, if in case there are preference shares, or if there is some kind of debt where you are not obligated to pay interest on a fixed interval basis or something like that, so in this case this capital gearing ratio will matter. Yeah, works? Any questions? Yeah. Chalo. So we'll move forward now. So we have seen two type of ratios. One is the liquidity ratios, which tell us about the company's current position or the company's liquid position, and then we have the capital structure ratios, which shows us how the company is being financed. Okay. Next, we'll come to the coverage ratios. Coverage ratios are again most important, wherein the company is not doing very well in terms of liquidity. Okay, so where liquidity is low, where liquidity is high, the current assets, the current ratio, the quick ratio, the cash ratio is high, you may not come to the coverage ratios. But if the company is going through a financial crunch and is experiencing working capital issues, then you need to have these coverage ratios as well. So now you might have heard of GDP per capita. So per capita GDP, or rather, I can say an example of there are roughly, say for example, 10 lakh students in WIRC. Okay, so there are 10 lakh students in WIRC, and say there is a team of say 20 people. There is a team of 20 people in Vikasa WIRC. So what is the coverage ratio? Can anyone tell me in the comments? There are 10 lakh students in WIRC, and there are 20 Vikasa members in WIRC. Yeah, can anyone? 50,000, 50,000, 50,000. Yes, right. So what is this 50,000? This is the coverage ratio. This is the coverage ratio. This is the coverage ratio that one Vikasa member has to at least cater to, or has to at least cover 50,000 students in the region. Right? One Vikasa member has to cover at least 50,000 students in the region. And there is a disclaimer in what we can say, in numbers का वास्तविकता से कोई संबंध नहीं है. These are just imaginary figures. I am not aware about the current figures. Yeah. So this is a coverage ratio. So we need to understand what coverage are we having in the company. Say for example, if we go to the first ratio, debt service coverage ratio. अब debt service क्या होगा कि I should have plenty of funds so as to cover my debt. So as to cater to my debt at least, because those are fixed obligation. और आपको पता है कि एक EMI नहीं भरो तो फिर बैंक कैसे तमाशे करने लग जाती है, राइट? So I have to understand कि whether my current cash flows will be able to service my debt obligations. जो मैंने उधार लेके रखा है वो क्या मैं दे पाऊंगा अभी करंट मेरी जो कैश फ्लो है उससे. सो फॉर दिस वील टेक the interest and the installments. ठीक है, यहाँ पे we are not taking expenses but we are considering cash flows, right? See whether my current cash flows will be able to cater to my current debt cash outflow specifically. अगर मैं बाकी सारी चीजें छोड़ भी दूं तो whether my current cash flows will be able to cater to my cash outflows. For this, what we'll take profit before taxes. We'll add up the depreciation and interest. क्यों इंटरेस्ट एडअप करूंगा मैं? क्योंकि मुझे इंटरेस्ट का ही तो कवरेज देखना है. तो मुझे कैश फ्लो में इंटरेस्ट कंसिडर नहीं करना, बिकॉज इट इज एनीवेज गोइंग आउट एंड इट इज बीइंग कंसिडर्ड. ठीक है, तो यहाँ पे व्हाट इज माय प्रॉफिट बिफोर टैक्स इज 20,000 and 26,000. डेप्रिसिएशन इज 10 and 11,000. Depreciation is a non-cash expenditure, that is why we are naturally adding it. There is interest 9,400, 9,900. So earnings available for debt, or rather cash available for debt. मेरा cash available for debt is what I have is 40,000 and 47,000. Wherein my fixed obligations. अब यहाँ पे I'll give you a disclaimer. ठीक है, यहाँ पे interest we have taken from the P&L, but जो balance sheet है वहां पे हम लोगों को क्या निकालना है? इंस्टॉलमेंट्स निकालना है. ठीक है, सो वी हैव अज्यूम दैट जहां पे जो लॉन्ग टर्म डेट है, the long term debt here is of 25 installments. I have to 25 years. I have to repay it in 25 years. And short term borrowings are naturally I have to repay it in within 12 months. That is why they are short term. ठीक है, तो we have divided this long term borrowings by 25 so that we can say what is the annual outflow, and then we have also taken the short term borrowings which are in full. Short term borrowings को हमने किसी से divide नहीं किया because I have to pay it all in the same year or in the period of 12 months. तो यहाँ पे interest is 9,000, installments is 38,000. तो fixed debt commitments, मेरा फिक्स डेट आउटफ्लो कितना है 47,000, मेरा कितना है 47,000. सो यहाँ पे हम लोग जब DSCR निकालेंगे विच इज अर्निंग्स अवेलेबल फॉर डेट डिवाइडेड बाय टोटल आउटफ्लो. सो if this is again a good ratio or not, I want it in the comments. The ratios come to 0.85 and 0.97. Is this a good ratio? Very bad, not good. No. No. Yeah. So again, I'll tell you, beauty lies in the eyes of the beholder. If I see with, yeah, it should be more than, ideally DSCR should be more than 2. Because ideally DSCR should be more than 2, because if it is 1, so I'll just be able to pay my debt obligations. What about the sundry creditors? What about the employees? What about the other people? Right? So यहाँ पे it is a bad ratio. It is indeed a bad ratio. But again, if you consider it on year basis, you can see that the company is trying to repay debt. The company is again trying to repay debt, or the company is trying to get enough of its earnings so that it can repay its debt. And this is what we have been inferring in the last 2-3 ratios. Right? Any questions in DSCR? Yeah. So I believe there are no questions in DSCR. We can move to the next ratio, which is interest coverage ratio. So now, what is interest coverage ratio? Interest coverage ratio is same as that of debt service coverage ratio. I'll just remove the installments. So here I can understand whether my current earnings or whether my current cash earnings can fulfill the interest, and that is why we have taken EBIT upon interest in the formula. Okay. So yeah, if it is PBT is there, I have added back the interest. So if we say interest coverage, so yeah, is this a good ratio or is this not a good ratio? Good ratio, yeah. It is a good ratio, because at least if I am not able to repay the principal amount, I'll not be at least making it up an NPA, and I'll be at least covering my interest coverage ratio. And this is a very healthy ratio as far as this balance sheet is concerned, that I have the funds which are three times what interest obligations I will be having, or I have. Not going to classify as NPA. Yeah, right. Because if you do not pay your interest, you get classified as NPA. So you can at least save yourself from getting classified as NPA, because there are a lot of negative things. All of us know what if we get classified as NPA. Very nice. Any doubts in this interest coverage ratio? I will see, move forward. Preference dividend coverage ratio. So preference dividend coverage ratio is nothing but in place of interest you take the preference dividend, and you adjust the net profit so as to not include the preference dividend in the effect of the net profit. Sadly, there are no preference shares issued by Vedanta, but this is, I believe, this is the same as what interest coverage ratio is. So we can, go ahead to the next one. Activity ratios, right? So now, now we have looked at the liquidity ratios, whether the company will be able to fulfill its short-term obligations, the capital structure ratios, how is the company funded. Then again, we have looked at the coverage ratio, whether the company is covering whatever it is. It has its crucial obligations rather. Now we'll have a look at their activity. ठीक है कि चलो the company is very good, then we'll have a look at the activity, that how is the company doing then. Everything is, if the liquidity is fine, if the capital structure is good, if the coverage ratios are good, then we'll come to the activity. Let's go to the bigger part then. Okay, so activity is measuring efficiency and turnovers. Total asset turnover ratio. What does this imply? What does this imply? This yeah. Okay. Okay, we are in the balance sheet. I was searching for the ratios. Yeah, total assets turnover ratio. Total assets turnover ratio implies how effectively we have put in our assets to use. ठीक है, आपने काफी आजकल चल रहा है कि पैसे को काम पे लगाओ. ठीक है, यू रेस्ट और आप पैसे को काम पे लगाओ. सो हियर यू कैन इन्फर कि आपने जो पैसे को काम पे लगाया वो कितना अच्छे से पैसा काम कर रहा है. सो वॉट एवर यू हैव इन्वेस्टेड इन योर एसेट्स, हाउ गुड आर द एसेट्स गिविंग यू, or what or in if I say it in technical language, what amount of sales is being generated per rupee of assets invested. Yeah, so मैंने assets को जो काम पे लगा है वो कितना अच्छे से काम कर रहे हैं, right? So if I divide, I am waiting if इसमें आपको कुछ question है, so that we'll proceed with the calculation. So this comes to 0.39. इसका मतलब क्या हो गया? Is this a good ratio or a bad ratio? Can anyone tell me? I'm waiting for you guys. Bad. Okay. Jay says bad. But the average doesn't seem to be correct. The average doesn't seem to be correct. So these are the opening assets, these are the closing assets, and oh yes. Very good observation rather. Yeah. I am sorry for that calculation error, and very good observation. Average of TA is incorrect. So now upon correcting it, what does it infer? Is it a good ratio or is it a bad ratio? Yes, anyone? Good, bad, good, bad, good, bad, good, bad. Again, यहाँ पे we cannot make an inference because unless we compare it with the industry standard, we won't be able to see whether it is a good ratio or a bad ratio. But if you say that the assets are able to generate 79% of the sales of their cost. So if we see if we at least consider 20-25% gross profit, so the assets will be able to repay themselves back in the coming 5 years roughly. Got that calculation? Yes, looking for you into the comments. No. Okay, Jay. Say 152, I have a sale of 152. So considering I have a GP of 0.25, okay, that is 25%. Why is it doing through into 0.25? Yeah. So my net profit is 38,000. My gross profit is 38,000. And the average assets that I have is of 1,94,000, which I divide by this. So assets will pay themselves back in a term of 5 years. So if I generate 38,000 profit every year, considering everything to be stagnant, the assets will repay for themselves in 5 years, and then I'll be able to use those assets on a profitable purpose. Now you get that? Yes. Chalo. Very nice. Let's move on to the next ratio, which is fixed asset turnover ratio. Again, this is total assets, this is fixed assets. I see here averages. Yeah, correct. So we'll again do it with fixed assets and current assets. So is this a good ratio or a bad ratio? Again, you will have to compare it with the industry standards, but seeing the ratio, the fixed asset ratio, the company, the assets will pay themselves back in a period of, if we consider 25%, so they'll be able to pay them back in a period of, say, roughly 3 years. Okay, got that? Yes. Chalo, next is a very important ratio, inventory turnover ratio. Inventory turnover ratio. Inventory turnover ratio is why it is important for me, because I have to understand ki the inventory that how much of my capital is getting blocked into the inventory. right? If I am able to roll my inventory multiple times in a year, I am into fast moving. And if I have fast moving inventory, if I am not able to roll my inventory, if I'm not able to roll my inventory multiple times a year, there is a possibility that I might have to think of classifying the inventory into fast moving and non-moving, and I'll have to eliminate the non-moving things. So again, inventory turnover ratio is COGS upon average inventory, which if I take that, okay, average inventory is again incorrect over here. This should be average. Yeah, this should be average. So inventory turnover ratio is 8 times. Inventory turnover ratio is 8 times, which infers that in a period of 12 months, my inventory has rolled on for 8 times. My inventory has rolled on for 8 times. If we take 12 divided by 8, so roughly in every 1.5 months, my inventory is recoming in 1.5 months, and I am carrying an average inventory of 1.5 months, which is a good ratio or a bad ratio? Yes, into the comments. Good ratio. Okay. Okay, good ratio. Yeah. So again, you'll have to at least go to 3 or 4 peers of Vedanta Limited, and you'll have to say what is their inventory turnover ratio, and then you can make an inference upon it. But if speaking generically, 1.5 times is the good inventory turnover ratio. Chalo. Right? So these were the activities ratios. We can measure what quantum of activity is being happening in the company. Next, come to profitability ratios, one that we have been churning our fingers from a lot of time. I believe there are CA students who have been doing this gross profit ratio. I want you guys to answer in the comments. How do I calculate the gross profit ratio? GP upon sales, very nice. GP upon sales, GP upon sales, GP upon sales, which is 25% and 28% roughly. Yeah. So what does this infer? This infers that the company is earning 25% directly on its sales, right? We have not taken the indirect expenditures. Next is the net profit ratio. How do I calculate it? Into the comments. Yeah, NP upon sales. Very nice. NP upon sales, NP upon sales. So here is something we need to brainstorm our minds right now. See, the gross profit ratio in the last year, yeah, calculation is the easy part. Let's go to interpreting these ratios. Okay. So we have seen gross profit has risen from 24% to 27%, right? Which is still a 2-3% increase, which is still a 2-3% increase in what we can say from the previous year. So we can understand that company has become more efficient by 2-3% from the last year. But if we take a look at the net profit ratio, it has improved drastically. It has improved drastically, so that we came to understand that how the company is very determinant towards cutting its expenses. The company has cut its below the line expenses, below the gross profit expenses, or rather the indirect expenses, to an extent that it was able to achieve an 8% growth in the net profit. And this is something very appreciable. So right from the beginning, we have been seeing that the company had poor debt equity ratio, the company had a lot of debt. But if you see an year-on-year picture, you can understand that what the company is going through right now. The company is going through a total transformation where the first agenda of the company is to repay the debt, and then the second agenda, or rather the parallel agenda, is to arrive at a good profitability. Right? Yes, anyone, anything? Or we should move on to the next ratio? Chalo, let's move on to the next ratio. I believe I am near the time, but let's see. Return on investment or return on capital employed and return on assets. Okay. So what is return on investment? Return on investment, see, there are two things. इन्वेस्टमेंट का मतलब क्या होता है कि मैंने जितना पैसा कंपनी में लगाया द टोटल अमाउंट ऑफ द मनी दैट आई हैव पुट इनटू द कंपनी वेदर थ्रू इक्विटी और थ्रू डेट. Understood? So return on investment is nothing but net profit as a ratio of the capital employed or the investment made. Okay, so यहाँ पे equity में हमने we have 42,000, in debt we have 87,000, the total capital employed is 1,29,000. The net profit comes to 7,500, and the return on investment or the return on capital employed is at a whooping 6% and 14% in the current year. Again, this communicates us the same story, that the management has been working on its expenses, on its profitability, and we are seeing the results. See, I'll tell you how to identify poor ratios. Okay, or how to identify whether a ratio is falsified or is malified. So in the whole story, we have been seeing these two major things, that the company is repaying its debt and the company is focusing on its expenses, rather cutting its expenses to bring up the profitability, and simultaneously is focusing on taking up the turnover so that it would also contribute to more profits. But what thing we need to understand is all the ratios have been communicating the same story, right? So this can give you a green signal, or this is a green signal. What I talked about it initially, left and right, that meant ki you should not see only one ratio. You should see all the ratios. You should look at all the ratios. If all the ratios communicate the same story, if all the ratios communicate, naturally it won't give you the 100% same story, but ratios are indicators, and if they indicate you towards the same destination, or towards if they give you the same indication, then those ratios may not be malified. But if the ratios give you very different indications, then you can understand that there is some problem, and then you can deep dive into the books of accounts. Got that? This is what we call as what we call this as. Can anyone tell me in audit terms? Anyone into the comments? Analytical process, yeah, analytical review. So risk no, Meet has the correct answer, analytical review. So what we do in audit, we take an analytical review, and if we find that the analytics are not communicating a good story, or all the analytics are not communicating the same story, we deep dive into it. Okay, chalo, we are nearing our time, so we'll go to the next ratio, which is return on assets. So similarly, what we calculated return on investment, we can calculate return on assets, wherein we'll instead of capital employed, we'll take the amount of assets. And again, it is communicating the same story, that initially it was 4% in the last year, but it has come to 10% in the current year. So the return on assets has also being a very good ratio, telling us a very good story. Yeah. Let's go to the next part. यहाँ तक has anyone doubt till here? Because we are nearing to the last 5-10 minutes of the session rather. So if anyone has some doubts, or we'll take the next few ratios quickly and then come up to the conclusion part rather. Just ping in the comments if anyone has some doubts, or I'll go to the next ratios. Yeah, no one? Chalo, good. I believe there are just like ratio analysis, if I don't see any comments over there, there are either two things कि सबको सब कुछ समझ रहा है, किसी को कुछ नहीं समझ रहा है. तो I think the first part is the case right now. Let's go to the next part of ratios. These are the profitability ratios. Profitability ratios we have already, यहाँ पे हम लोग जब P&L में आएंगे तो we have this EPS. EPS, all of you knows, you have been calculating in the what we can say in accounts. हम लोग ने EPS काफी calculate किया है. You know, we have to take the weighted average of the shares, or I have mentioned in over here the formula, but the time does not permit us right now to go into a deep calculation. But I believe the calculation of EPS is covered in your syllabus. Similarly, it is dividend. Similarly, it is dividend per share, DPS. What is DPS? Can anyone tell me whether DPS can be higher than EPS? Whether DPS can be higher than EPS? And you have the answer on your screen. Not possible. No. Can be. Okay. Can be. No. Yeah. So technically it should not. But I would want to take you to the provisions of Companies Act for this. ठीक है. Companies Act में dividend payment के लिए क्या provisions दिए है? That, yeah, exactly, Kalpit. That you can pay dividend using the previous year's profits. Right? You can pay dividend using the earlier year's profits. And if you paid, even if you do not have profits in the current year, if you pay dividend using the current earlier year's profit, so you can have dividend per share more than EPS. And I don't know whether you know about this company fundamentally or not, but Vedanta is, leave all the ratios aside, Vedanta is a very good company in terms of dividend. The dividend yield that company gives is very amazing. Here also you can see the dividend payout in the year 2024 was 259%. 259% of what? 259% of EPS. Are you getting my point? So if you see what was the dividend payment in 2024, so it was nearly 30 rupees, and for 30 rupees in the previous year and 43 rupees in the current year. Whereas the EPS was much lower than these two numbers. Are you getting that? Is everyone getting that? Or is there any doubt? This is a very good analysis, and Vedanta is a very good company in terms of giving dividend. So here also you can see the dividend payout is 259% and 113%, and that is in real value it has grown from 29 to 43. The only reason it has gone to 113% is there has been increase in the profits. So there has been increase in the EPS. If you see, EPS is more than tripled, but still the dividend payout is more than 100. So now you can understand how good the company is in paying dividends. Yeah? Anyone? Any doubts? Just ping me in the comments so that we can go ahead. No. Chalo. The last ratio we are coming to is PE ratio. What is PE ratio? I will show it to you live. If we go to this is screener.com. Sir, Vedanta's borrowings are highest ever, then also paying dividends. Yes, it is. But it is repaying the dividends as well. No? It is repaying the debt. It is in the process of repaying debt, and that is why it is paying good dividends. And Vedanta has a history of paying good dividends. So even if it has high debt, it has to first service the debt aspects, the debt commitments, and then it can pay dividend. There is no what we can say. There is no rule like that if you have debt you cannot pay dividend. You do. So if you come to Vedanta Limited, you can see यहाँ पे इसका PE ratio is at 13.1. So what is PE ratio? What is PE ratio? PE ratio is the ratio of the current earnings to the price. आप लोगों ने, you might have seen in Shark Tank that the valuation they do is mostly on the basis of their revenue, right? But when we take valuation on the basis of revenue, is when the company is not making profits, or if the company is into its early stages, right? Then we take the revenue as a multiple to determine the valuation. But when the companies are established, when the companies are doing good, they have a good history, they are generating profits, then in order to arrive at the valuation, we do not take the revenue as a multiple, we take profits as the multiple. So as you can see here, PE ratio is the multiple of the profits to the present market price of the share. So with that you understand that if whether the company is valued at what multiple, and if it is undervalued or overvalued. So right now I just want this last thing into the comments. If you can see, the stock P is 13.1. The stock P is 13.1. Whether this is a good ratio or not. Yeah, into the comments. Good as well as best. Very good. Very good. Okay. So I'll just show you यहाँ पे screener.com पे so आप अभी यहाँ पे देखेंगे, yes, आप अभी यहाँ पे देखेंगे, I have added a ratio which is industry P. Yes, exactly, Kalpit. The multiple at which the stock is trading right now is 13.1. But if you compare it to the industry in which Vedanta Limited operates, the industry PE is 36.6. The industry PE is 36.6. So you can understand. But sir, वो उसके average PE से कम he to not good na. Yeah, it is not good. That is what I am telling you. You cannot infer looking at the PE individually. You will have to look at the industry PE. You will have to compare it with the industry PE. अगर मैं industry PE से compare करूँ तो what is its EPS भी यहाँ पे हम लोग डाल देंगे. EPS is 38.3. So if I take it at 38.3 into 36, it was, oh sorry, 36.6 into 38.3. 36.6 into 38.3. Yeah. So the value comes at 1400. Whereas Vedanta is just priced at 464. Please do not take it as any indicator. Okay, this is just the markets perform very differently. You have the best person as your Vikasa chairman to guide you on this. But this is what I was wanting to tell you. Yeah, this is not any indication. This is not a buy indication. This is not a sell indication. This is just to inform you that if you take PE as an indicator, if you take PE as an indicator, Vedanta is very, what we can say, very much undervalued. So last thing in the comments, what do you think? Why is it so undervalued? Why is the industry PE so high but the stock PE is very less? Someone already talked about this in the comments. I just want you people to run your brain, to process your brain and make it understand that why is it so. What could be the possible things? Not exactly because of this, but the industry PE is at 36 and the PE of the stock is at 13. Risky as high debt. Yes. Other income ज़्यादा नहीं, other income ज़्यादा नहीं, other income normal है. Meet is again towards the right directions, because आप देखो डेट इक्विटी हमने कैलकुलेट किया 22-23% वहां पे इक्विटी है, बाकी का 46-47% डेट है. So there is a lot of debt into the company. There is a lot of debt into the company, because of which the industry PE is much more higher than the stock PE. Because you do not only consider the profits, you have to consider a lot of aspects, multiple aspects. Okay, so this could be a possible reason, or this is a possible reason why the stock is so undervalued right now. But I believe as soon as the stock starts paying off its debt, I am seeing a very good future of this company. Yeah, company is indeed facing challenges, because having so much of debt, you do naturally face challenges, though it be company or an individual. A high debt thing is somewhat problematic always. Yeah, so let's come to our PPT again, and these are the ratios. There is a lot of ratios as we talked about, but as I have already told you that beauty lies in the eyes of beholder. So the interpretation of the ratios lies in the eyes of the analyst. The only thing you have to see is if all the ratios communicate the same story. The the chances of they being malified is very less. But if the ratios do not communicate the same story, the chances of they being malified is much more. But still, ratios are like indicators, those are like traffic signals. If you see your signal green, then it is not compulsory that you should directly go. You should see if anyone else is not breaking the signal, so that he does not harm you in going forward. And that is how you have to look at the ratios. You have to look at the ratios from all the perspective. So and one more thing I would suggest you, that if you do ratio analysis, don't do it for a single year, because we have seen यहाँ पे single year में the ratios communicate a bad story, but if we compare it over 2 years, the story gets being better and better, right? The story gets being better and better, and that was, sir, due to high debt, then how company is able to manage to pay off significant high dividend, because it has got good earnings. No, you can see how much earnings. See, the earnings that the company has it after paying off the interest. The company would have done two things out of the earnings that it is doing. The company would have repaid debt, or the company would have paid. आज say for example, I earn 50,000 rupees in a month. Okay, and I have 20,000 worth of EMIs going on. ठीक है, EMIs includes both my interest and my principal part. So 50,000 में से 20,000 I have to pay into the EMIs. Suddenly my income goes to 1 lakh. Okay, suddenly my income goes to 1 lakh. So then it is my point of view whether I will repay that debt first, or whether I'll spend that money into something else. Maybe if I get an increase in my income, I may put it into make my family happier. I would take them onto trips or whatsoever. I can buy gadgets and do such things, or else I can pay off the debt. I have two options. Similarly, the company has two options. Whatever it is remaining after paying off the interest and installments, it can rather prepay or repay the debt first, and then pay the equity shareholders. But the company has to keep the equity shareholders happy at the same time. So that is why it is managing to pay such dividends. So the company not investing its profits in the business rather than giving dividend is good or not. See, again, this is from the point of view of an analyst. This is not a good thing, I can say, but what is a blessing in disguise, that the company is keeping its shareholders happy. See, if the company is unable to repay its debt obligations on time and still giving dividend, then it could have been a much more worse thing. Yeah, the company should have ideally used the profits in into the company and make it debt free first. That's what the general principle says. But that is against the management's call, and we are profoundly seeing it in the terms of what promoters hold while the public holds. So indirectly, money are it. Yes, Kalpit, you are going into the right direction. See, promoters hold 56%. So whenever they pay dividend, 56% of the dividend goes into the hands of the promoters only, right? And if not the even if the promoters holding would have been much more lesser, it is, we need to understand the same story what I told, that if I double my income, I have two options. Rather, I repay my debt first fast, or I can expend it into whatever luxuries I have planned for myself. So this is not a good thing, this is not a bad thing, this is just a management decision. Okay, Sainath is saying, excellent, sir. Thank you. I take this as a indication that now students are, um, getting like, chalo sir, ho gaya. ab." Yeah. So we'll conclude this. We'll conclude this 3-4 learnings that we have seen. Ratios, calculating ratios is a very easy part, but analyzing them is a very a technical part. You need to use your logic. You need to use a professional skepticism. You need to take a look at it from each and every angle that you could. Take multiple years while calculating ratios so that you can have a better picture of them. And lastly, if the ratios tell the same story, they may not be malified, and if they do not tell the same story, there is a higher possibility that they may be malified. So this was it from my side. I am open for any discussion if you guys want, or else you can connect me with me anytime. I have my contact details over here. Yeah, not a problem, Sainath. It was just on a very friendly note. Yeah, it was a really good session. Thank you so much for having me here.
Hello. Sir, am I audible?
Yes.
Sir, it was really a great and insightful session. We really had a great learning.
Yeah,
And
thanks so much.
I hope that you two had a good audience.
Yeah. I was amazingly. I've been a part of Vikasa, so I do understand how difficult it is to keep the audience engaged, and I'm very happy seeing the chats that everyone was engaged into the discussion.
Definitely, sir. Definitely. Like in our previous sessions as well, students have been very attentive and attached to the speakers. They usually keep on asking the doubts, and today's session was quite engaging. Even when I was getting some queries, I was about to put those, and when the next point or further few points were explained, I was satisfied with the answers I've got. Like I didn't got an opportunity to put any questions forward to you. It was really great having you. Thank you so much uh, for the for taking the session forward. I would request Ms. Ashi Chirania, Managing Committee Member of Vikasa WRC, to kindly present vote of thanks for the session.
Yes. What an enriching and insightful day it has been. On behalf of the organizing committee, it is my absolute honor to deliver the vote of thanks for today's exceptional event. First and foremost, I extend our deepest gratitude to the visionary leaders of WRC. Thank you to CA Ketan Sayasa, Chairman of WRC, for your constant encouragement and for championing initiatives that empower the next generation of chartered accountants. A heartfelt thanks to CA Piyush Chandak sir, Vice Chairman of WRC, whose unwavering support has been instrumental in making today's program a success. We are equally grateful to CA Gino Savla ma'am, Secretary of WRC, and CA Farid Shah sir, Treasurer of WRC, for their valuable contribution to the student fraternity. A special thank you to all the WRC Regional Council members for being the guiding force behind such meaningful student-centric events. We are also immensely thankful to CA Jitendra Saglani sir, Chairman of Vikasa, for his consistent support vision, and dedication towards student development. Your leadership truly makes a difference. Now, to the star speaker of today's session. A heartfelt thank you to CA Udit Choithani, sir, for your brilliant and deeply informative session on ratio analysis, where to look, interpreting financial signals with clarity. Your ability to simplify concepts and present them with such clarity is truly commendable. With a rich experience as a speaker, educator, and active contributor to the community, today's session reflected not just your expertise, but also your passion for empowering students. We are grateful for the practical insights you shared and the valuable knowledge we now carry forward. A huge shout out to all the coordinators and team members who worked tirelessly behind the scenes to make this event seamless. And of course, to our wonderful audience, thank you for your enthusiasm, attention, and active participation. Events like this become meaningful because of your involvement. Thank you once again, and wishing you all the very best on the journey ahead.
Thank you so much. It's been my pleasure to be a part of the growth stories of so many students. Thank you for having me.
Thank you, sir.
Thank you so much, Ashi. Uh, thank you so much, sir, for your time, and we hope and expect to have you for a physical session offline at BKCWIRC very soon.
Sure, right. It will be my pleasure to host a session over there. Yeah. Thank you.
Definitely, sir. Even sir, if we could get your PPT, so it would be great. We would have to share that with students.